So what you can see here is what's called the snapshot. This is like the main screen. Whenever you make a retirement plan for someone, we already know that there's going to be things that happen. And when you're really looking at the three things that we sort of want to check the boxes on to make sure someone can enjoy the retirement and have just the best time ever, one is we got to make sure we have a predictable income. We have to make sure that the money is right. But two, once you have the money right, what are you going to do with your time? Because you purchase all your time. That's why sometimes we call retirement planning financial freedom. And I can appreciate that. We always want to rename things, but retirement planning is financial freedom. It doesn't sound as sexy, but our goal is to make retirement planning sexy again. So you want to have your money right, predictable income, and that could be anything. And I'll show you there are several streams of income that the IRS says they recognize, and the reason that we focus on generating at least three streams for everyone. And then two, you got to figure out what to do with your time. That's really what happiness comes from. I read this book called Happiness by Design, and they said that the two things that they notice over and over again that dictates whether someone is happy is how you spend your time. And that could be on things that bring you pleasure and things that bring you purpose. And if you spend your time on these things, then you're going to feel better about retirement. That it's not as much about the money, it's what we do with our time. Who do we want to meet, the things that we want to do, the causes we want to support. If you have your retirement plan filled with these things, and I call it the beginning of happiness, and you will have a really good feeling about retirement. And I'll share some data with you on that as well. And then the third thing, of course, is we got to make sure that it's designed in a way that if something crazy happens, I'm still okay. Because we do know that things happen, that we can plan for the perfect scenario, and things don't always work out that way. We have things where we live longer than we expected. Taxes are higher than we thought. Social Security is less than we thought. Inflation is higher than we thought. We have different sicknesses and ailments that we go through. There's a lot of things that we have to consider when building a retirement plan. And so we'll go through a handful of these different situations for you. And so it's a great place to start where you see what we have as an 80% probability of success. And the reason we shoot for 80 is because we're basically saying in 1,000 scenarios, and I'll show you what some of those scenarios are. We're saying that 80% of the time we come out with money left. And we were talking about living 5 years longer. We're talking about the stock market going down 20%. There's a lot of scenarios that we test. And going for 100%, while that could be something that we could go for it, I just find that generally speaking, if the stock market collapse 80%, then we have really big problems. And our retirement plan is not the biggest one of them. That there are some things that if it happens, then we have a lot more problems to deal with. And so that's why 80%, 70%, somewhere around there is normally going to be okay, we're in a good spot. And the cool thing is if you have a retirement plan, you can always revisit it. You don't have to say, all right, I put my plan in place. 30 years goes by. I can't change anything. Of course you can. You could always change something. So that's where that comes from. And then when you look at the numbers, that's how we end up getting this range. And so that's one of the cool things that is different for our programs that we use with Rare Capital and the kind that maybe you can Google where it says retirement calculator. If you put in retirement calculator, it's going to ask you how much money you have, how much you're going to save, and how long until you retire and what your expected return is. And then it just calculates that out and says, all right, well, that means that you're going to be just fine. But the reality is things happen. The stock market does go up on average over the long term, but doesn't go up every single year. That it is true that over the long term it goes up, but that doesn't mean every company that's ever been on the stock market still exists today. We know that many of them don't. So there are different things that happen throughout our retirement. And so when you take that in consideration, that's how we end up with basically a confidence interval. And without getting too wonky, all we're saying when you look at this number, we're saying, hey, what happens if our retirement plan is designed to live to 91? And we know that the average American would live closer to maybe like 75. And that's, women live longer than men and things like that. But let's just say we're shooting for 91. We're saying that there is a less than 5% chance that you'll have $0, right? Less than 5% of the time you have $0. And then we're saying that there's a less than 5% chance that you'll have $6.5 million. So one is saying that every single investment goes poorly. One is saying every single investment is a rock star. And so that's the less than 5% chance. We're somewhere in that 25 to 75% of the time, we're going to say we'll have somewhere between 243,000 and 2.8 million. So that's what we're saying when we look at that number, which then gives us the median of 1.3 million. We're saying that the majority of the time, you're going to have something. And we're going to say that roughly we should expect to have over $1 million left in this retirement account, even at 91. And we'll go through some of those. You have your balance sheet, so that's your net worth. Your net worth is always your assets minus your liabilities, and then that gives you your net worth. We have the current investment allocation, and we like to create what we call allocation models. So there's different studies. The studies will say that 90% of the time that you can, or not 90%, but the studies would say that the return that you get, 90% of the correlation, 90% of the results of the return you get is how you allocate the portfolio. And so we have different model portfolios that are tuned to generate a certain return over the long term. And so whether that is a 5% we're being conservative, or if we're going for 10% because we could be more aggressive, or anything in between, then we're able to say, all right, based on certain allocations, we're going to get a certain return. So their current allocation there, and they're about a 50-50 as far as invested in the equities versus bonds. And high level, that's probably a little bit too conservative. And then we'll go into that. And I'll tell you what to look for. And you can see when you look at their tax allocation, taxes is always important to consider. I tell people all the time, there's basically three levers that we have. We have the ability to retire later. So we have time that we can pull that lever. We can cut expenses. We can pull that lever, or we can make more. And sometimes when we talk about cutting expenses, what we think of is, okay, I'm going to not eat out at restaurants. Well, I mean, okay, you could do that. But what about taxes? Taxes is technically an expense that we pay out. If we're able to lower our taxes, could that be the difference in whether our retirement plan is successful or not? And so we normally will say, all right, well, then let's at least take a look at our tax allocation. And you can see what they have is what a lot of people have. Most of the time, you have your money in tax deferred accounts. And the reason we have that is because most of us are putting the money into our employer 401k plan. You could have a 403b or something like that. But for the most part, we're putting our money in tax deferred, which is great if we want a tax deduction today. The money also grows tax deferred, and then we take the money out. But when we take the money out, it's taxed as normal income. And so, do we want all of our retirement income taxed at normal income when we retire? And for different people, the answer is yes. And for different people, the answer is no. One of the first questions I would ask you is, hey, do you think you'll have a smaller or higher income in the future versus now? Because that's going to be question number one. If you think you will have more money later, then you probably should take the income tax now because you're going to be in a lower tax bracket. If you think you're going to have less money later, so you're going to retire, you're going to basically kind of chill out on the back porch and read a book, live a very simple life. Okay, well, if you're going to do that, then maybe deferring the taxes in the future is a great idea, where you can defer how much you would pay. And the reason it's important to always think about that is because it's not as much of a slam dunk as it used to be. There was a time in the 80s when this was created where that was always the answer was always yes, because about upwards of 90% of their income would have been taxed in the 1980s. That's why they created the 401k to help people defer all those taxes. But as you and I both know, we are currently in historical lows as far as taxes. The highest is 37%. So then the question becomes, do I think taxes will ever go up? And for the most part, I think we would say if you're in the lower income bracket, probably not. That for the most part, no one is talking about raising taxes on the lower middle class. The middle class is probably a coin toss. If you're on the upper middle class to the and above, then people do talk about raising taxes. We say like pay your fair share, right? So that is at least something that is discussed. So it just really comes down to whether you believe that you'll pay higher tax in the future or currently. But we'll look at that and we'll see. And then they do have a Roth, so that's where the tax-free money is. They have contributed some money to the Roth. And then this is our stress test, and I'll go through that with you. And these are their income sources. I'll go through that with you as well. So as far as the profile, I'll go over this really quickly with you, because the first thing that you want to do anytime you have a retirement is we always discuss what would your perfect retirement look like. Now, for me personally, I would encourage you to go for a list of 50 things that you would love to do, places you want to go, things you want to learn, places you want to eat, people you want to meet, autographs, events, concerts, things with family, and anything that has to do with a cause that you believe in. It could be donating your time, it could be donating your money, it could be donating your assets, anything like that. Just whatever you have on the list. We want to list everything. And then we'll put a dollar amount on it, which kind of throws people off, but everything does have a price. And then we'll say, all right, let's put a plan together. How many things are we going to do in 1 year, 3 years, 5 years, 10 plus years? And then we will decide how much that costs and put the plan together. So this one, we started off nice and simple. There wasn't a whole lot on the list in the beginning, and so I added some to help them out. But they definitely said we want to get a new car, so we added the new car in there. And then we'll say, hey, what year do you want to do that? And they would say, I'm thinking like 2035. I was like, cool, no problem. And they said, we want to have a joint vacation home. I was like, oh, that's nice. Yeah, can I come too? And it was like at the cabin on the mountains. And I was there, how much do we think that home will cost? And so we'll say, I think it's about 250,000 now. And then when you put the year in, and then I will add the appreciation. And all that does is it basically does the present value calculation. So it's like, here, if it's $250,000 now, but it goes up by 3% every year over the next 3 years, what would that amount be? And so that's what's going to show up on their plan. And then we would have whatever our down payment is, or we're paying it off to completely. They wanted to be able to afford a wedding, and they wanted to pay for someone's wedding. And it was like 20,000. I was like, cool. Their retirement lifestyle was going to be $4,000 a month, and then they're wanting to retire at 65. And then we generally add your healthcare expenses with the national average. If you are very confident, you're like, no, mine's higher than that, or I'm positive mine's lower than that, then we can always change it. We have the ability to adjust it based on a detailed estimate where we place the amounts in there, or we can do it based on a customized amount where I just write the amount that you believe it would be. But for the most part, we normally just leave the national average. It's normally a good place to start, just as far as retirement planning. Healthcare expenses, I believe there's a Fidelity study that said about 150,000 of it would be for a single individual over the life of their retirement, and about 350, 400,000 is what a married couple can expect to spend in healthcare expenses over the life of their retirement. And it was everything from doctor visits to copays to their deductible to your annual premiums for Medicare, and plus the Part D. So it had a little bit of everything in there, and that's what the national average ended up being. And then they said they wanted to go on vacation. They said that'd be roughly about $2,000 every single year when they did it, and they would want to go every 3 years. I was like, all right, so we got our retirement. And then from there, my general recommendation for you is if you want to make sure you stay happy in retirement, every time that you check something off your list, always add something else back on. I remember listening to Jim Rohn. He always would say that he would always add things back onto his list. And I'm someone that agrees in that too, that if you have a purpose and a focus, that it increases the likelihood that you'll be fulfilled in retirement. Then because it's so much change, we're changing our identity, where our kids are grown, our identity when we talk to people might have been our profession. We're like, hey, what do you do? And then when you're retired, it's like, okay, like what do I do? What do I tell people? And so it's something that I believe we start restructuring and creating that identity, and it will help you out. So when you look at the overall expenses, I already told you we had that there. In savings, we contribute about 12.5% to the 401k, 12% for James. There was nothing in a taxable account. Everything was in the pre-tax, which is what you saw. And then you can see that they had the Roth that we contributed 5,000 each of them into a Roth and 3,000 into the HSA account. And so the health savings account is one of my favorite accounts. If you do have a high deductible plan at your employer, you have access to a health savings account, and it's your triple tax benefit. You have the ability to put the money in tax deductible. The money grows tax deferred, and the money comes out tax free as long as you spend it on healthcare expenses, which we'll all have in retirement. So I do like that account a lot. That's definitely something that I would encourage you to be able to do. And so they had that, so that was good. For the income, so John, I believe he's an attorney. No, he was an accountant. Makes 80,000 a year. Jane was a teacher. She makes $50,000 a year, and then the Social Security is estimated. As you get closer to retirement, we can go on the Social Security website and add the exact amount in there. When we looked at their net worth, so they basically we have the loans, we have our mortgage, we have the automobile, the investment accounts, those are set up, and then the bank account where the money is at, that's set as well. So then that gives you the information that then is fed into this plan. And when you look at the second aspect, so we're talking about the first aspect, which is, hey, what are my values? How do I want to spend my time? What will bring me fulfillment? Because that's something that's very important in retirement. It also helps you with that transition too. The second thing that we normally want to take a look at is going to be what we call the stress test. And all the stress test is it's basically saying, we're going to see if I can get this to open. And all the stress test is basically saying, hey, what is our chance of success if certain things happen? And so we said we had about an 80% chance of success, or 8 out of 10 times we're fine, right? So out of 1,000 different scenarios, well, it says, what if the market drops immediately? That's called sequence of returns. Fancy way of saying that if you lose money at the beginning of your retirement, it's almost as if you're withdrawing extra money. If you think of it kind of that way, it's like if I was going to withdraw 4%, but then your account lost 5%, it's like you took out 9%. And I think you and I would agree if I had a 9% withdrawal rate, then it's probably decreasing my chance of having money at the end of my retirement. And so that's why the money dropping immediately is something that we look at. And so when money dropping immediately, we're saying 20%. So whatever a 20% drop right out the gate, it would go from an 80% to a 70%, decreases 10% of the time. If we have a 20% drop at the beginning, then we're going to run out of money before 91. Remember, we did say 91. The taxes, we said we have a 66% chance of success. What do we look at for taxes? It says if my taxes are 20% higher. And so then you start looking at these. Okay, so a 20% drop in the market isn't as damaging as a 20% increase in my taxes. Right. For this particular person, because as you saw, they have all of their money in pre-tax, which means that they are going to be paying taxes on all of the money the way their investments currently are. And then you see Social Security. What do we say? We said, what if Social Security reduced by 20%? And Social Security is, I think, is projected to run out of money like 2041. That number kind of fluctuates depending on what we do each year with the government, but that's where it's currently projected at. And then longevity is saying, well, what if I live longer than expected? And it says how much longer? We're just saying 5 years longer. You only drops you 5%. Inflation, we're saying what if inflation is just 1% higher? And right, inflation is a big deal because all of your expenses go up. That even a 1% increase in inflation over your retirement is a big deal. And that's why it's important that we keep an eye on things that cause inflation, whether it's overspending or different things that we see popping up with the government, that we got to keep an eye on that. Healthcare expenses, you can see that we went from an 80% to below a 70%. In healthcare, we're saying that a 20% increase in healthcare costs, which unfortunately isn't as crazy as it sounds. And then our asset returns, that we just didn't get the performance we expected. If our asset returns are 1% lower, then that dropped us to 62%. So you can see the things that drive the loss for this particular retirement plan the most. And so then it becomes the goal to generate a plan that ensures that we don't run out of money before we're supposed to, because right, that is the goal. So then when you come back, I'll show you what we did now as far as designing their plan. So there's a couple things that we did. First is we did change their investments, where we said, all right, look, right now we are at like a moderate, about 50-50 allocation. But what we actually could do, because we're in our 40s, I think we're in our mid 40s or early 50s. What we could do, we have the time where basically if your money's in the stock market for at least 5 years, for the most part, we feel pretty comfortable about being around a 60-40 at least. And then there's different ways you can design this to have that allocation. This is simply one example. And so this is one that could be a little bit more on the aggressive end, where we have US equities, the international and emerging markets. But you can see that ultimately we end up still around that 60-40, and that would get us an average return of 8% versus the 7.4% standard deviation increase slightly to 10% versus 8.6, which is basically 9%. And then down here, we say, all right, what does that mean? Well, that means that I would increase my equities by 23,000. I would increase my investments in REITs by 1,500. I would decrease my cash investments because we're too far from retirement to be that conservative. I would decrease my bonds by 20,000, same idea. And then I'll increase my international and I'll increase my emerging markets. And then my international bonds, I would decrease. Again, this is simply one example. There's lots of ways to design a portfolio, but I do want to share that one with you. All right, and then so when you move to the overall retirement, when you move to the overall retirement plan, you can see that what we had originally, even though we were investing 12% from each of them, that we only had a 14% chance of success. And it's largely because of where the money was located. When you increase it to 80%, we're going to go through some of the changes that we made. So one of them is we changed the allocation to moderate. And so anytime you see the blue, it lets you know that we made a change. Social Security, we simply waited till the full retirement age, where even though they weren't working at 65, we still said, wait 2 more years, just take Social Security at full age. Now, of course, in this particular plan, because we're estimating we'll live to 91, then it makes the most sense. But if you're just wondering, high level, you probably need usually about at least a decade, maybe sometimes somewhere between 10 to 15 years for the math to work out for you to hold off on taking your Social Security. Because for the math to work out, you basically have to take the amount that you started already taking out. So if you were getting, I don't know, you're getting $15,000 a year, you have to take $15,000 a year, add that up from 62 to 70. And then you have to take your larger amount that you started at 70. And how long would it take for me to surpass those amounts because I started earlier? And now is so for most people, that means that you would have to believe that you're going to be living somewhere at least past 80 for the most part to wait all the way till 70. But for most people, if you wait the full retirement age, which is 67 for most of us, then that normally works out very well as well. But I do think the number showed that 40% of people take the money out at 62. I think it's like 40, 50%. It's a pretty large percentage. And then I'll show you the tax proposal, the adjustments that we made for them. And then the retirement spending, we use the retirement spending smile. It's just a withdrawal strategy. And the reason we use the smile is because in the way it would look, and I probably can find you an example of it. But the way in the retirement spending smile, the reason that a lot of times we end up using that is because for most of us, we end up retiring and then we spend a lot of money, right? The very top of the smile. And then somewhere along the way, we're kind of done sleeping at the airports, we're done having our trips canceled. We're kind of ready to just chill out just for a little bit. So then that decreases what your spending is, right? The lower part of the smile. And then as we get further into our retirement, we end up spending a little bit more on healthcare expenses. And then so that ends up closing the last portion of the smile where now we increase it again. And so that's what the retirement spending smile is. And that does work for most people because most of the time that's exactly how our spending habits are, that we have something very similar to a retirement spending smile over the life of our retirement. And then we had the property that they want to get in 2028. Looking through the numbers, it ended up being where we had to make one of two choices. And for each of us, you either can say, all right, how about we retire 1 year later? If we retire 1 year later, then great, we can get that second vacation home in 2028. But if you want to retire at the same time that you mentioned at 65, then we're going to have to wait 2 years on the vacation home, that second home. But it's your choice, right? We either, like I said, we have three levers. We have the time that we wait to retire, we have the expenses, and how much we generate as far as income. But let me show you what that would look like just working one additional year, real quick. And so you can see that each of them working one additional year would increase their portfolio by an additional $1 million and increase the probability of success to 94%. And you're sitting there saying, well, Dre, how could 1 year cause that much of a benefit? And I'm glad you asked. The reason it does is because for each of us, there's a few things that are happening. One is if I start withdrawing the money, then there's money coming out of my investment account. I'm also not putting any more money in the investment account. And then so I'm already spending out of it and I'm not putting anything in, right? Those are two levers that are being changed when I retire. But if I wait to retire even one more year, what you're able to do now is you're able to invest another year. And that's one less year of you taking money out of your investment accounts. And so as a result, that ends up exponentially increasing the results that you get. Now, that's definitely a case by case. You have to love your job, you have the good health, and a lot of different factors you need to consider. But it's simply saying that that is always something that you could consider. Now, as you already saw and mentioned for them, they said, look, Dre, we don't want to do another year. So we said, okay, if you don't want to work another year, then let's go ahead and buy the vacation home 2 years later. And then let's start increasing the investments that we have in our taxable accounts. And so I said, let's start increasing what we put in our taxable accounts. And they were like, okay. And the reason we did that is because I already told you and what I told them. If all of our money is going to be in a pre-tax account, that means all of our money is going to be taxed as normal income when we retire. But if I start having some money that I take the taxes on today and I put it in a taxable account where it's just invested in the stock market and different things like that. Well, now when I receive that money in retirement, if it's been invested for at least a year and a day, now that's capital gains, which is a much more favorable tax rate. It's about half of what most people's normal taxes are. And so I said, okay, the goal is to have the most income that we can have in retirement. That would be the approach that we would take. So then we have the Social Security, we have the investments, and then we have the Roth accounts. So you have the tax-free money. I believe that that's going to get you the results that you want. And they're like, all right, well that makes a lot of sense. So I see how that could, how that could work for me. So that's where we agreed on to go with that. And so then that is their plan and the change that we made. Now let me show you from the tax perspective why that ended up increasing it so much. All right. Now, at the end, I will, of course, I'll answer any questions that you all have. So if you do have any questions, feel free to leave them in the comments, and hopefully, I'll see them. If not, because it's the first video, I'll make another video where I answer them, or I'll do a better job of keeping track next time. So what we can see here from an estimate of our taxes, we're saying, okay, we're still working, we're still working. One of us retires, both of us retires. And then as a result, we're not paying the FICA and the different FICA tax anymore, and we're just going to pay whatever the tax rate is. If all the money is in a pre-tax account, then we have to pay that. And then you'll see that we start spiking somewhere usually around like 70. And the reason that is because, do you want to take a guess? Because they're required minimum distributions. So when you have all your money in a pre-tax account, Uncle Sam says, I've been waiting a very long time to get my tax revenue. And sometimes that means that we have to take out more money, even if we have no intention of spending it, because you either can take it out or pay a 25% tax on the money that you should have taken out. And for most of us, we take the money out. Now, there are a variety of strategies that you can use to limit that. But it is important to know that if all your money is in a pre-tax account, you are going to have to pay, or you're going to have to at least take the money out in required minimum distribution amounts. And so that's what we ended up dealing with there. It caused the increase. And then we started spending those accounts down. And then we were able to kind of work through that. And then we always add basically the long-term care. So the way I think of it, and you hear me say it all the time, 7 out of 10 people 65 and older will have at least one long-term care episode. And what that ultimately means is if long-term care on average, if you have a home health aide or you go into assisted living facility or a nursing home or something like that, well, that's going to be on average about $40,000 a year. And so even if we don't believe, right, I'm healthy, I walk, I eat right, fruits and vegetables, straight and narrow drain, I like to just add it on the last 2 years. Or let's just say the last 2 years we do have some health things that we have to address. Are we able to do that? And so that's what you see that last spike is those last 2 years. And so then ultimately, what we ended up deciding to do for them is the proposed strategy. We're actually able to generate $707,000 more in their tax adjusted assets. And they're going to say, all right, Jerry, what was the change that you made to be able to generate them more money? And they paid about $100,000 less in taxes. Where again, that's one of our levers. We put more money in their pocket. They were able to then that technically decreased their expenses and it worked out really well for them. So then ultimately that means that we had about $30,000 less withdrawals from our tax deferred account. We're able to leave it in there. It's ultimately up to you what you end up deciding as far as your legacy plan. But the big thing that we changed is so the first one is pro rata. And pro rata is a very fancy way of saying I'm going to take even numbers out of all of my accounts because, right, not a big deal. And that's obviously an option. What we ended up changing, and it can vary for everyone, it depends where your assets are to know what withdrawal strategy makes the most sense from a tax perspective. For them, because they didn't have as much set in the taxable accounts, because we started that a little bit later, and they did have the tax-free account, which wasn't quite that large. The thought was for this particular situation, if we're able to get rid of their taxable accounts and their tax-free accounts, then all they'll have is their tax-deferred accounts. So even if they have those RMDs that are kind of large, we've already gotten rid of all the other accounts. So you don't think about it as much. But that's not something that we would do for everyone as far as just the allocation of the accounts. And then we open actually, I misspoke. So actually what you often do is you take your tax-free accounts last. Sorry about that. You do normally the tax deferred and then the taxable accounts. You do those two first so that your money that's tax-free keeps growing. So that in the end of your retirement, all you have is tax-free money. And that's what we kind of all want. We want Uncle Sam to leave us alone. And so that's what we were able to do for this particular one. And then we did not do any Roth conversions. It did not make sense for them in their particular plan, but this is where we normally would look at doing Roth conversions, and then we will make those adjustments. High level, the idea of a Roth conversion is if I have RMDs later in my retirement life, or at 73, I'm going to have these. The thought is, what if I'm able to, instead of at the end having Social Security, maybe a pension, and my income streams for my required minimum distribution, instead of me having all three at the end of my retirement, all required to come out, there's no way I can turn any of them off. What if I'm able to start taking some money out of my tax deferred account, my 401k, and I pay the taxes whenever I have low tax years leading up to 73, and then I move it into a tax-free Roth account. So that's what a Roth conversion is. That's what a backdoor Roth is, if you ever heard those phrases. And it works normally pretty well. If you have $100,000 in taxes that are sitting in your 401k, would you rather take $10,000 in taxes each year over 10 years? Would you rather take $100,000 in 1 year? And so that's the idea of a Roth conversion. That's why it ends up working pretty well for us. It ends there. All right, so we do have one question. Let's see who that is. Oh, that's the missus. She's Wanders the Yams. She said, you talked about a super tax benefit of an HSA. Is there another account that functions similarly to an HSA and or has a similar tax benefit? That is a good question. Putting it on the spot. The short answer is no, right? Short answer is no. You have accounts that normally have one function. So the way you would think of it is you have some accounts that you can do tax deferred, like your 401k, 403b. That money you get to take a tax deduction today when you put it in. The money grows tax deferred. You're not paying taxes every single year that your account grows, but you 100% pay taxes when you take that money out. That money is going to be taxed when you take it out. And there's something that's called like a ticking time bomb. I forget the fancy term for it, but it's the idea that I leave it all in that account and then I pass it to my spouse and they have to pay taxes on it because I didn't pay any taxes on it. Or if you pass it on to your children, they only have 10 years and then they have to pay taxes on all of it within that certain time frame. So sometimes we even talk about that ticking time bomb. So no, there's no other account that's pre-tax that you can do that. Your tax-free account, your Roth account, while that money grows tax deferred, and the money comes out tax free, you put the money in from your taxable income. So you still have the tax deferred and the tax free distribution from it, but you put the money in with your taxable income. You did not put the money in tax deferred. It was taxed, put in your bank account, and then you put the money inside of your Roth. And then I'm trying to think if there's really any other ones. And then no, and then the other ones like your regular invest in a business or real estate, the stock market in general, all of those are going to be taxable income money that you've already paid taxes on at least once. And that Uncle Sam allows you to have significant tax deductions in the business. There's so many write-offs that you can do. So you have a lot of benefits that there. But even that, even if you do capital gains, you still going to pay taxes, even though it's a lower tax amount. So you would do that. Let's see. And then, yeah, Ronald said, "Pay now or pay later." Huh? Yes, a true statement, my friend. Yes, yes. Uncle Sam is not super generous when he said, "Look, I'm going to get my tax money at some point." And in fact, that's the only reason that the backdoor Roth is even an option. Because when you look at the Roth, there are contribution limits. A very fancy way of saying you have to be making below a certain amount to be able to have this tax-free income. And then in I think 2008, 2009, the government was doing the TARP and all that stuff and they said, "How are we going to generate more tax revenue, gentlemen and ladies?" I use gentlemen in the generic term. And they said, "How about we allow the wealthiest amongst us to take money out of their 401ks and they can pay taxes on it today and put it in a tax free Roth account, i.e., in the backdoor Roth." And they thought about it and they said, "Yeah, you know what? That would generate a lot of money today. And then they won't have to pay taxes later, but we want the tax revenue today." And so that's exactly what they did. So Uncle Sam is 100% interested in making sure he gets the money in one way or another. And so excellent, excellent question or point, Ron. Good to see you as well, my friend. All right, so with this particular one, we took the taxable money out first, then you took the tax deferred second, and then we left with the tax free third. And so that was able to generate them, as you see, additional $700,000 in their taxable income, $100,000 less in taxes, and then they were able to withdraw $300,000 less because they didn't have to take out more. Right, your money's working more efficiently. The way you would think of it is, if I had to take out $100, but Uncle Sam takes 30 of it, well, then I got to take out more than that if I need $100. But if I could take out $100 and Uncle Sam takes zero of it, well, then that means that I don't have to take out as much money. And that's what that third column is. You don't have to take out as much money if you're able to do that. And so that's what ended up working for this particular situation. As far as insurance, they were great on that. They still had their term insurance, they had the assets as well. So we didn't have to really worry about that. High level for most of you, you want to have insurance that probably brings you to either your retirement. So we're talking about risk protection, disability insurance, probably bring you up to retirement because I had a client, he wasn't really a client, but it was someone that I had discussed with and I talked to regularly, but we didn't end up doing anything. But he ended up having some sort of a stroke or there was something that happened with his brain or something. He was an engineer. He was making a lot of money and he wasn't able to do that work anymore. He could work, but he couldn't do that work. And it was a significant pay cut, but he had another 10 years or 5 years until retirement. And so sometimes we're thinking, okay, I need life insurance because I don't, what happens if I die too soon? But we don't always think about what happens if I live too long, right? And so there could be a variety of things that could be draining from a health perspective. That so you want to be thinking about disability insurance. You definitely want to think about life insurance depending on your age and your assets and things like that. I've seen it where life insurance is used for solely to be a liquid asset for when you pass it on to the next generation because you don't want them to have to sell some of the assets to pay the taxes when the assets passed along. So there's definitely a lot of things to consider. And then I've already showed you a lot of those stress testing environments where you have your money invested in a certain way for certain environments. There are asset classes that perform better in recessions, and you're going to have at least one recession in your retirement. On average, it's one every 10 years. So you have to be thinking about these things. What am I going to do with my investments? How am I going to design my investments to make sure I'm okay when that happens? And so then you can also look at long-term care. It's about 150, $200,000 over the life of your retirement because it's about 50,000 a year and it's about 3 years on average. That's the over the life. Not saying it's 3 years in a row, but just over the life of your retirement, it's about 3 years that you'll end up having to pay for something, physical therapy here, some assistance there, someone to visit you, just different things will happen. Not that it happens for the whole time, but I think we've all just done things where we've been injured and we needed some help. And so we want to make sure that we have that stuff covered as well. And so when you look at that, where you can take all the three pieces together, right? High level, that's generally what gives someone a fulfilling retirement experience. They have fulfillment and joy and how they spend their time, and whether it's on purpose or pleasure. They normally have a future proof plan of some kind where we go through a variety of risks and we make sure that we have a plan in place for them. And then we went through the stress test where it lists a handful of those risks for you. So it's just always something to be able to take a look at. And so everything from the stock market going down to inflation up, social security down, all these different things. How am I performing in these different environments? And then that's how we future proof things, right? And so I know that I've done it. I retired from corporate America and I said, this is going to be great. I have no problems. I'm a healthy person. And then I had to rupture my patella tendon, right, my kneecap ripped right off. And I had to have a surgery. And then I had caught malaria when I went to Nigeria, which was crazy, right? I know. And I didn't have health insurance. And I had to figure out how to pay these different expenses. And so we're planning for the best case scenario, then we're probably just wishing because something's going to happen. Right? Just something's going to happen. So just at least plan for a handful of them, like what are our contingency plans? And then that's how we feel comfortable about our retirement plan in the future. And then the third one, of course, is we need a predictable income stream. And 65% of self-made millionaires have at least three streams of income. And those three streams could be everything from a business perspective, you can have profits from a business, capital gains from asset appreciation, you got rental income with your real estate and different things. You can also have that within your business. And then the stock market gives you interest income, which is what you get in your savings account each year. You have your investment income, which is dividends. You have capital gains as well when you sell the assets. And then you have like royalties. You got royalties in the business or in the company you're investing in. And when you have these streams of income, if you have three of them, then you're normally in a pretty good spot. And so that's why three is normally the magic number. Because if you could, right, I don't have a whiteboard. I'm sure it's here. I just haven't used it before, so I'm not going to push any buttons. But in the future, I like to draw, so I have the whiteboard. All you're basically saying is, what do I think will fill the bucket up quicker? Do I think one stream will fill the bucket up quicker, or three streams will fill the bucket up quicker? I think we would all agree three streams, of course, would fill the bucket up quicker. And for me, it's the idea that if you want to stop working, at some point we have to have our money work for us. Like the money has to work. And Albert Einstein said compounding interest is the eighth wonder of the world. And I think that's pretty cool. But when I think of it that way.